the whole purpose why we're doing this, and I forgot to turn the recorder on. My bad. All right. So again, accounts receivable, notes receivable. And so, you know, the first thing that we, can you guys see that, or is it, no, I didn't. Hang on. I got to share that with you guys first of all. All right. So chapter 11, accounts receivable, notes receivable. Let's do this for a third time. And so the sources, you know, as such, you can read all that. The nature of notes receivable, the audit risk of receivables, our mantra, the objectives of auditing receivables and revenues, because again, those go hand in hand. Internal control over accounts receivable and revenue. Oh, and so I remember what I started to talk about. You know, we want to have appropriate structure and lines of responsibility. And so what we're referring to here, right, you know, right at this point, we want to, you know, make sure that, you know, we have checks and balances, right? And so, you know, a transaction can't just be approved by, you know, the low man on the totem pole. That there's got to be some sort of structure and responsibility tied to that. And usually it's a dollar amount, you know, so we allow, you know, a bookkeeper or something like that to make some decisions, but really the large dollar amounts, you know, has to go up the chain of responsibility. Commitment to recruit and develop and retain competent employees. Again, you know, a lot of this is somewhat review. We want to make sure that the people that we hire can do the work. And this really kind of ties into the second objective of internal control, which is accuracy of information, right? Because if you don't know what you're doing, you're going to make errors. And then there's, you know, obviously holding employees accountable, all right? And, you know, identifying defined roles and, you know, authority. And so risk assessment, risk of misstatement of revenue may be high based on its nature and complex rules regarding revenue recognition. So continuing on with the internal control activities, all right? We're going to prepare a sales order, okay? You know, so, you know, in the process of making a sale, all right, you know, we're going to have clients that, you know, put together a purchase order. Okay? And for us, that may represent, you know, our preparation of a sales order. Okay? We're going to make sure that we call on, you know, their, the people that they've listed on their credit application, right? To make sure that they're a quality person that they're going to obviously pay, right? That they're going to pay what is owed, right? And again, I think I said this last time that, you know, make sure if you're in that situation where you're approving credit apps, okay, that you actually call to make sure that they are a, you know, a credible, you know, customer. We definitely issue merchandise from the stock, all right? So, you know, we probably have some sort of pull ticket or something along that line. So we pull that. We make sure that it's shipped properly, all right? You know, that we have the proper, you know, FOB designation on that shipment. Then subsequent billing, you know, so from all that paperwork, we fill out the invoice, okay? Maintenance and control accounts, you know, so, you know, the use of subsidiary ledgers, all right, you know, customer ledgers, you know, and the control account would be, you know, we post to the control on a monthly basis, but we update the subsidiary ledgers on a daily basis. And then when stuff is returned, all right, because obviously we're going to reverse that sale, all right, for returns, sales returns, and allowances, because they're bringing the stuff, or they're shipping the stuff back, or we're giving them allowance. All right, and so I'm sure I shared with the bulk of you guys about those orange T-shirts and green board shorts that we sent out to Makaha, right, from Tate's Riding Company. The difference between a return is that when they actually return the product, where in allowances, we're inducing them to keep the stuff. And that's what actually happened to the product that we sent out to Makaha Surf, because they were just, at the time, really ugly and not popular colors. And so when we shipped it all out there, the guy called and was like, what am I going to do with all of these orange T-shirts? And thankfully, Tony, I gave the phone to Tony, and Tony said, hey, we were selling our T-shirts at the time for $9 at wholesale. And, Tony was like, hey, how about if I knock off $1 per T-shirt, and I think it was like $3 per walk short. And the guy kept it. He kept the inventory, but yet what we did is we reduced his accounts receivable, and we reduced that sale. And then authorization for write-offs of uncollectible accounts, right? And so, that's that whole process of, bad debt expense utilizing the allowance for doubtful accounts. Revenue cycle, all right, as far as the documents go, all right, so we received the purchase order, all right, from our customer, okay. We created a sales order from that, and at SMC, at Faith Riding Company, we basically we put that information, we were using QuickBooks, and we basically created this thing called a poll ticket, all right, which then we gave to our warehouse guy, and based on the design and the size, he pulled those orders. Then the bill of lading is the information that is filled out, all right, and so if we're sending it with FedEx, we're putting the product listing in there, so that when the customer receives it, it's their choice, right, to either use a blind receiving report or to actually use that bill of lading, right? Because the bill of lading is basically saying, hey, this is what's supposed to be in here. And especially when you do international transactions, you can't send things internationally if you don't list the stuff. Then obviously billing, we're going to create the invoice, all right? And then when we receive the cash receipts, all right, we want to make sure that the amounts correspond with the invoices. So if they send a short, why did they send that? Okay. Then there's the authorization of a credit memo. And again, we are the ones that generate a credit memo based on our customer's debit memo. Right? So for us, a credit memo is that we are crediting the accounts receivable, all right, or the asset that we have. And so here's a nice pretty picture, okay? Hopefully you guys remember all this from systems and controls, all right? And so again, there's a bunch of control steps in here that make sure that we're properly recording those accounts receivable and revenues. So switching gears, we're now looking at notes receivable, okay? Again, with notes receivable, we want to have subdivision of duties, right, or segregation of controls. All right, so we want to make sure that the custodian of the notes receivable should not have any access to cash or the general accounting records, right? Again, we want to keep those responsibilities separate. The acceptance and renewal of notes are authorized in writing, right, by a responsible official who does not have the custody of those notes. And then finally, the write-off of defaulted notes are approved in writing by responsible officials, and effective procedures adopted for subsequent follow-up of such default notes, like taking them to court. Risk assessment of the audit of receivables, okay? Use the understanding of the client and its environment to consider the inherent risks included, including fraud and relative receivables related to receivables and revenue. Obtain an understanding of internal control over receivables and revenue, right? So we're going to test their system, right? Identifying the controls that are in place. Assess the risk of material misstatement and design further audit procedures, right? So details on understanding the client's business. So we need to have a good understanding of the types of products and services that are sold, the classes and categories of the client's customers. We have some reoccurring customers. We want to definitely look at large dollar amounts. Whether the business is affected by seasonal or cyclical demand. Most retail, right, don't actually turn a profit until after Thanksgiving, right? And that's why we call it Black Friday. Typical marketing policies for the client in its industry. Policies regarding pricing, sales returns, discounts. Right? And so a lot of this you're going to find in the procedure manuals of your client. Compensation arrangements that are based on recorded revenue. Right? So, Faith Writing Company, we had our sales force were 100% commission based. Right? So if they didn't sell, we didn't pay. Right? And so, we want to recalculate those things, right? Because, if you can understand the salesperson, they want to get paid, right? So there's the possibility of them inflating those receivables. And then typical revenue recognition principles used in the industry and their methods of application. Fraud risk related to receivables and revenue. Okay. Understand controls established by management to control those risks. Determine controls have been implemented. So just because they have the controls, are they actually being put into practice, right? And then, the responses to those risks, right? An over effect on the audit, so if we find weaknesses in here, how does that impact the audit as a whole? Alter the design of the audit procedures, right, to hopefully overcome, right, those risks, and perform procedures to address risk of material misstatement due to management override of internal control. Because if you remember, there's controls are only as good, right, as the humans that implement them. Because any control can be overridden, right, through collusion. So if you have two people working together, right, to circumvent the controls, that's called collusion. And so potential misstatements, okay, so recognizing revenues not yet earned, okay, and so this, falls back to, accomplishing the cutoff and things along that line. All right, so there is the possibility, with fraud, recording fictitious sales, right, without actually, having the client order anything, right? Or there could be the intentional overshipment of goods, right? This is what's referred to as channel stuffing, all right, where somebody puts a legit order in, okay, but you send them more than they actually ordered, okay. Once it gets there, then you try to entice them, right, to keep the stuff, right. Now, generally, to entice them, what you're going to do is you're going to give them an allowance, right? And so, we made a mistake. We overshipped you. Oh, we're so sorry. Hey, but if you just keep that stuff, instead of paying us $9 a t-shirt, just pay us $8. Well, you have to deal with that because you have to, create a credit memo. And so one way to discover this, all right, is, by looking at a detailed review of, the proper authorization and the dollar amount of those allowances that are given, or credit memos. With that, however, you could make some mistakes, right? And so you can read, how those mistakes could be made. Now, it's kind of funny because, when it comes to, fraud, maybe I just have such a naive mentality, right? But usually it's like, well, how would I commit fraud, right? I really didn't know that very well until I started teaching this class, all right? And so they've told me, all right, how to commit fraud in most of these situations, right? So early or late recognition of revenue, okay, so that's a definite cutoff problem. I brought that up earlier, all right? Holding sales journal open to record next year's sales. The problem with this, okay, again, we're recording revenues this period, and we're stealing from next period. Okay. To keep this up, you're going to continue to have to steal from the next period, right? So, don't get into it to begin with, all right? And then again, there's some errors that can be made there too. Recording revenues with significant uncertainty exists, all right? And so, overestimating revenues by understanding the effects of the customer's right to return, all right? And so, we're doing this specifically, we're recording the sale at the end of 2019, knowing for a fact that they're just going to return that stuff at the beginning of 2020, right? And so, again, we can commit fraud in that way. Recording revenues with significant services, right? Performance obligations still must be performed by the seller. Okay. So again, the fraudulent behavior here, recording the franchise revenue when the franchise are sold, even though the obligation to perform significant services still exists. Right? And so that would be a fraudulent method. And by the way, yeah, you can, I'm leaving some of the reading to you guys. You can read, how to overcome those things too. Overestimate of the amount of revenue earned. Okay, so overstating the extent of performance on several contracts, by a computer software company, right? Or saying that we're 40% done with this construction project when in reality, we're 32% done. Things along that line. So additional tests of controls. So after looking at the control systems and we find strengths and weaknesses, right? Then we try to evaluate, hey, what else do we need, so that we can have confidence, right, to give these people an unqualified opinion. Well, we're going to perform further audit procedures, right? We're going to test those controls. So some examples of tests, right? Examine significant aspects, right, of the sample of sales transactions, right? And so, we could do that using, sample sizes, all right? But in reality, and I think we're going to have a slide on this in a little bit, with data analytics, we can pretty much test all those transactions. We can compare a sample of shipping documents to related sales invoices. So if we recorded a false sale, okay, we wouldn't have the shipping documentation for shipping nothing, all right? And so that's what we're looking at those. Again, those are looking at the source documents to legitimize a transaction. Review the use of authorization of credit memorandums, right? Reconcile selected cash register tapes and sales tickets with sales journals, test the IT application controls, examine evidence of review and approval of revenue estimates, and if necessary, revise the risks of material misstatement based on the results of the test of controls. And so here, all right, would be an example of a audit check sheet or internal control check sheet. And so we can see that the control that we have proper segregation of duties over sales and collections of receivables. Why we have that test, so that we can observe, make inquiries about the performance of various functions. And each control, all right, if you remember our mantra, we talked about the existence, right? We talked about this existence, all right, and occurrence, completeness, the cutoff, right? Rights and obligations, valuation, right, and then presentation and disclosure. Right? And so each of these controls, right, give us an assurance, okay, on each one of those areas. And so substantive tests, okay, we're going to perform further audit procedures, all right, or substantive procedures over receivables. And really this, substantive tests, again, are, the legwork. All right, you're going to do additional testing. We're going to send out confirmations. All right, we're going to look at source documents, things along that line. And so in reading these things through, all right, we want to obtain an aged trial balance of trade accounts receivable and an analysis of other accounts receivable and recorded ledgers. And so I don't know if you guys remember from Accounting 202, or I'm sorry, it's actually Accounting 201 when we did, the allowance for doubtful accounts. One of the methods, we could just take the percentage of receivables, right? And that's the one I usually defaulted to, right? But then you have, this aging of receivables. And it's obviously, if something is over 300 days past due, there's a higher percentage that is not going to be collected, right? Where if there's something that's just 5 days past due, more than likely we're going to be able to collect that. And so by looking at these aged trial balance, right, basically that's what it is. It's an aging of receivables. Obtain analysis of notes receivable, right, and related interest, so the recalculation of interest on those things. Inspect notes on hand and confirm those with holders, right? Confirm the receivables with debtors, right? We're going to look at different confirmations. Review the year-end cutoff of sales transactions, right? Perform analytical procedures for accounts receivable, notes receivable, right? So again, analytical procedures, we're going to be looking at things like number of days in sales and inventory. Okay? We're going to be looking at the accounts receivable turnover ratio, and there's various other ones. Review of significant year-end sales contracts, right, for unusual terms, so a sale buyback, right, was a very common, year-end, way to manipulate your revenues. Test the valuation of notes receivable, right, compute the interest income, interest receivable, so, things that we have an accrued interest on. And the amortization of a discounted premium. Evaluate the propriety of a client's accounting methods for receivables and revenue. So basically, look at how your client deals with those things. Evaluate accounting estimates related to revenue recognition. Determine the adequacy of the client's allowance for uncollectibles. Ascertain whether any receivables have been pledged, right? So with pledging, there's pledging and factoring. Okay, so a pledge is basically, saying, hey, when we get this in, we're going to send you that money, right? And so that takes money away from normal operations because we're going to we pledge that money to somebody else, to our creditor. Investigate any transactions with or receivables from related parties, and evaluate the business purpose of significant or unusual sales transactions. And finally, evaluate financial statement presentation and disclosure of the receivables. And so, for the most part, okay, these are all the same things that we just read. Okay? But what they're doing is they're identifying the primary audit objectives, okay? Evaluation accuracy, existence, cutoff, and so on and so on. And you can see the relationship between those. So, one method that is widely used is the use of confirmations. Right? And so receivables should be confirmed, right, unless accounts receivable are immaterial. Okay, so generally they're not, right? Faith Writing Company, we had very few cash sales, right, or COD, right? Everything was on account, right? So, even Faith Writing Company, as a percentage of total revenues, right, I think it was probably close to 95% was on account. Use of confirmations would be ineffective, all right, or the auditor's combined assessment of inherent and control risks is low, and the audit risk can be reduced by acceptable low levels of substantive tests. And so again, taking into that video we watched about ZZZ Best, right? They were creating these receivables, right, for clients that didn't even exist. And multiple times he said, hey, if the auditors even just did a drive-by, okay, the address. You know, they would have easily seen that, hey, there is no building there that they're restoring, right? And so, you know, these confirmations, all right, you know, are good to an extent, all right, but you know, we definitely want to do additional testing. And so here's the confirmation, right? The overall process, okay? In the ledger, okay, we see that we have a subsidiary in our accounts receivable subsidiary ledger. That ABC company owes us $220,000. All right, so we send a confirmation to that company, right? The CPA determines the confirmation request is directed to the appropriate confirming individual and address, right? And so again, we want to make sure that's a legitimate customer, right, for our client. The confirmation request is delivered, okay? And again, with all confirmations, we're the ones who send that, all right? You know, so we want to have control over those confirmations. ABC company receives the confirmation request, right? And then they confirm, right? The party, confirming party receives and responds to the confirmation request. The response is delivered directly to the auditors. We don't want this going to our client and then the client giving it to us. So there's different types of confirmations, right? There's two types that specifically we're going to talk about. There's the positive confirmations. That's the request addressed to the debtor asking for a reply, all right? And so we're saying, hey, how much do you owe, you know, our client, right? Magoon Estates. How much do you owe Magoon Estates? Originally sent with the balances due on them, all right? So it makes it easy for them. So, you know, December 31st, the subsidiary ledger says that the Magoon Estates owes our client, you know, $40,000. We send them a letter, and all they have to do is sign that, right, or put their initial next to the $40,000. Blank forms, however, all right, you know, we require that they fill in the amount that they owe. Right? So it's used less frequently because, again, we're trying to get a response, and if we make it too difficult, you know, that customer, okay, might not send it back or even do it, right? The other method is this negative confirmation. We ask the debtor, all right, to advise the auditors only if the balance shown is incorrect. So again, this is not as strong as the positive confirmation. It gives us a low level of assessed risk of material misstatement. Large number of small balances. We would use this with large number of small balances. A low error rate is expected. So the only time we would use these, okay, are when these bullet points were in place. And no reason to believe that the respondent would ignore our request. So the flow chart of the confirmation sequence, right? Yeah. So we, the auditors, right, select the accounts for confirmation, identify the information to be confirmed, determine the timing and extent, choose the appropriate confirmation form, right, and so forth. And so, you know, I just read it backwards, but basically we're going down this way, right, and then we're going up like that. So we're going to develop our audit objectives. What are we trying to achieve? Choose the appropriate confirmation form, determine the timing and the extent, identify the information to be confirmed, select those accounts for confirmation, prepare and mail the request, send second request for positive confirmation so if they didn't send it back, perform alternative procedures for non-respondents, okay? And so you remember, you know, the guy from ZZ Best, you know, said that, hey, you know, if we had listed at the year end an accounts receivable and, you know, for a certain dollar amount, you know, $12,000, and then, you know, in early January, you have $12,000, you can see that we deposited that $12,000. You know, the best way to prove the existence, right, of a receivable is that you got paid, all right? And so if we didn't get those confirmations, we would unfortunately have to result to those sort of procedures. If we do find exceptions, we need to resolve them, right? And then we're going to document that process. Data analytics comes in, right, when we are concerned about the sample size. Right? And so, again, data analytics is basically using computers to audit computers, right? Identify possible fictitious revenues by searching for unusual or large entries in the revenue accounts. Identify possible fictitious revenues by searching for entries into revenue accounts from unusual sources. Identify possible revenue cutoff errors by examining unusual revenue transactions around year end. Identify related party transactions in the sales journal by selecting unusual transactions throughout the entire year. Identify possible duplicate billings by reviewing the sales journals for sales of identical amounts to the same customers over a short time period. Identify possible unauthorized sales discounts by comparing discounts to individual customers in total and as a percentage of total sales. Identify possible uncollectible amounts by identifying credit sales that exceed the amount of customers' credit authorization. So we would only give them a $5,000 credit limit, okay, but yet their accounts receivable balance in the subsidiary ledger is $8,000. Okay? Why did we sell it to them, right, over their credit or authorized credit amount? Identify misstatements of accounts receivable by identifying large credits to accounts receivable from unusual sources. Steps for recognizing revenue. Okay. The first step is identify the contract. Right? So this goes to the whole new rules around revenue recognition. We identify the contract, okay. Identify the performance obligations, okay. Determine the transaction price, allocate the transaction price to the performance obligation, recognize revenue when the performance of the obligations are satisfied. I think that's SAS, what, 95? I don't know, that for some reason sticks in my mind, but don't hold me to it. Oh, no, there it is. It's FASB 606. So potential revenue recognition problems, all right? We could have sales with unusual right to return, sale buyback, side agreements, all right? So, hey, if you do this, if you buy this, we'll service this free of charge or something like that. Franchise fees are, there's, if somebody owes us money, okay, usually there's with franchises, there's a lot of things that we have to do, right, before we can actually record that as a revenue, right? And so franchise fees is a really complex revenue recognition issue. Bill and hold transactions. So, we put it into our system, and we wrapped it all up, but it's sitting on our dock, right? And so we treat it as if it was a sale when in reality it's not. Sales using notes with unusual interest rates. Long-term construction contracts is always an issue. Multiple element arrangements, so in intermediate, when we walked through the revenue recognition rules, and we kept adding those additional components to the contract. So that's what we're talking about. When we have to do or utilize estimates, okay, revenue recognition may involve a lot of those things, right, especially with construction in progress. Auditors can evaluate these estimates, right, by reviewing and testing management's methods of developing those estimates. How did you come up with that? We could also come up with our own estimates, or we could review subsequent transactions and other events that provide evidence about the accuracy of those estimates. And in a lot of cases, you can also pull from industry averages, right, to really see if they're following along within an acceptable range. The auditors are required to perform retrospective review of prior year's significant accounting estimates to determine whether or not they were legit. Yeah. When we're looking at allowance for doubtful accounts, all right, hopefully you remember that the direct write-off method is not GAAP, all right. However, a lot of people use it because it's such a, they don't have that many people who don't pay them, all right. But generally accepted accounting principles requires that, you know, larger corporations either use the allowance method based on receivables or based on sales. And so we're going to do a review of the collections in a subsequent period, right? To evaluate whether our estimates were accurate. Develop, estimate, and evaluate reasonableness of management's estimate. Compare the details of the aging of accounts receivable to the prior year's aging, to really see if there's a shift. And by the way, I do want to say that this can also be an indicator. Not only is it an indicator of your ability to collect, right, which is an efficiency thing, right, but it could also speak to the state of the economy, right? Because I can tell you what, all right, those accounts receivable are going to be stretched out more and more and more now that we're in the start of another recession. Do I think that recession is going to last? No, I don't. I just FYI. I think once we turn the tide of this virus, okay, that once people start returning to work, it's really going to be a stopgap situation. The underlying factors of our economy were strong, except for this virus, right? And what's impacting our economy is a lot of uncertainty, right? And now it's because of all the people who can't work, right? So, you yourself might be affected by that, and worrying where that next, paycheck's going to come from, right? And so you're going to hang on to your money, right? And so you're not going to pay what you owe, you're going to hang on to it. We want to investigate the credit ratings for delinquent and unusually large amounts, review confirmation exceptions for an indication of amounts in dispute or other clues as to possible uncollectible accounts, summarize in working paper those accounts whose collectability is doubtful based on the preceding procedures, list customer names, doubtful accounts, and reasons for considering these accounts doubtful. Review with a credit manager the current status of significant doubtful accounts, and then compute relationships such as the number of days in sales and accounts receivable, and the relationship of the valuation allowance to the accounts receivable and the net credit sales. So several of you guys, I believe, had Bill Beckman as an instructor at SMC. Bill has a really interesting case when it comes to this whole idea of manipulating income through receivables and payables, right? And so this, if he's told you the story, or I told you the story in the past, this is when he was in Brazil and he worked for an oil rig company that manufactured oil rigs. It was a subdivision of Halliburton, okay, which is always in the news, because they're always getting caught, right? But basically, he blew the whistle on I think it was an $800 million misstatement in their financial statements, and this was the deal, all right? And so they were the ones that were building this oil rig, right? And so they hired subcontractors, right, to do a lot of the work. These subcontractors would actually bill Halliburton, or the subsidiary of Halliburton, the amount. Well, unbeknownst to, and I guess this probably would be a better story when it comes to the accounts payable side of things, right? But the accounts receivable from those subcontractors is what was in my mind. So the subcontractors would bill, all right, so it was accounts receivable for the subcontractor and accounts payable for Halliburton subsidiary. But Halliburton would contest some of those charges, all right? And what made me think of that, was a comment up there, what was it, compare. Okay, yeah, this area right here, the review of exceptions for an indication of the amounts in dispute. Okay. And so they would dispute these charges, but instead of recording them as a reduction, right, so from Halliburton's perspective, they wouldn't record that as a reduction in the liability. They actually booked those as a revenue. Right? So they're like, hey, the likelihood that we're not going to have to pay this is high, and so they actually booked it as revenue. In some cases, they hadn't even informed the subcontractor, okay, that they were in dispute. All right, and so if you were auditing one of those subcontractors and you sent a confirmation letter to the Halliburton subsidiary, okay, that's where they're going to dispute the amount, right, of that receivable. Looking at related parties, right? We obviously want to identify any related party transaction. Okay, and again, just because it's a related party does not mean that it's not legitimate, right? But with related parties, we want to make sure that that there's an arm's length transaction that's going on there. Proxy and other filings with the SEC or regulatory agencies. So these are the things that we're going to review. Conflict of interest statements by management, transactions with unusual terms, accounting records for unusual balances or transactions particularly near the year end. And then determine the related party transactions, are they properly disclosed? As it comes to audit documentation, of course, we're going to be recording all our tests, right, and our findings in our working papers. So we're going to prepare a lead schedule, right, which lists all the accounts receivable, notes receivable, things along that line. We're also going to have the net revenue. And then we're going to prepare the working papers, right, the aging of receivables, analysis of other accounts receivable, analysis of notes and related interest, right? So again, when we're looking at the interest, okay, we're also auditing the interest revenue side of things. Analysis of the allowance for doubtful accounts, right? Again, we're doing the matching concept there. Comparative analysis of revenue, right? So again, we're looking for trends. Documentation of the internal control, and then the risk assessment and the audit plan or the audit program. Cool. And that's the end of the contents. Right. And so I'm going to go ahead and post this. I'm going to stop the recording. Hang on. I'm going to discard that inking. I can find there it is. Or not. Oh, you're over here. So. All right, little technical difficulties on my part. Hang on a second.